It is Christmas time, it is sweater season, and I'm feeling particularly generous. That's why in this video here, we're gonna go through the remaining 4 titles out of the Max 7. The first 3 I already tackled in a previous video. And with those 4 remaining Max 7 titles, Tesla, Nvidia, Google, and Meta, we're gonna go through all of our target zones in great detail with the exact coordinates for entries. And of course, our targets for 2026 and the full outlook here in this video right after the intro. Hello and welcome to another video by HKSTM Global. My name is Joe, and 2025 really was an interesting yet difficult year for the Max 7 titles. First of all, of course, AI was the driving narrative fueling the Max 7 companies, while at the same time the Max 7 companies fueled most of the S&P 500 gains. And that's even though the Max 7 themselves, as you saw in the previous video, there's quite a few of them that didn't even perform greatly at all year to date in 2025. That's what actually many people forget and make a mistake there, and I'm gonna show you that mistake in just a second here directly on the chart. But overall, year to date, the performance for the Max 7 titles mostly isn't all that great. And in just a second, we'll discover why that is. And secondly, we saw a huge dispersion in valuation amongst the Max 7 titles themselves. So there were a few that exploded and there were a few others that really stagnated. And mostly, yet again, the dividing factor between those two camps amongst the Max 7 was, of course, the AI narrative and hopes for the AI future. And directly, we're starting off hot with Nvidia, the #1 most valuable company in the whole wide world, currently sitting at over $4 trillion in market cap, 4.2 roughly. And if we take a closer look at Nvidia, we see a PE ratio of currently 43 for the end of 2025. So 43, sure, is expensive. And I don't need to tell you about the explosion in stock price for Nvidia. But let's not neglect the earnings in Nvidia, because they exploded as well. I mean, look at this chart here. Are you kidding me? I don't know whenever I have seen something like this in the stock market. So for example, going back only 6 years to 2019, we were looking at Nvidia earnings of $3 billion for 2019. We were for 2020 looking at $4.5 billion of earnings. 2021, a real nice $10 billion of earnings. 2022, 4.4 again, so a real downer there. But then coming into 2023, $34 billion. 2024, $84 billion. 2025, an expected $116 billion, starting out of only $4.4 billion in 2022. So in 3 years, what's this hand doing? In only 3 years, we jumped from $4.4 billion to $120 billion in earnings. So that is a 30-fold increase in earnings. Absolutely mind-boggling. And so it's no wonder that in 2025, Nvidia successfully defended their title as the undisputed backbone of the whole AI economy infrastructure, a title that they had rightfully earned in 2024. And so again in 2025, the demand for Nvidia GPUs far exceeded the supply that they were able to pull up. However, a PE ratio of almost 45 rarely comes without investors wondering and fearing whether we might be running into a bubble and whether we really are looking at an overvaluation here in the Nvidia stock. So that, on the other hand, a real downer for Nvidia and its performance. But then again, what was the performance really? And for that, we're gonna go straight here to the 4-hour chart, and we're gonna go into our scenarios in just a second. But firstly, I will take a look together with you at the year-to-date performance for Nvidia, because as you remember, back in 2024 we saw a real rally in tech right after the election of Donald Trump. Ever since his inauguration, we then saw this whole chaos around tariffs, and then we saw the resulting TTC, the Trump tariffs crash, meaning many companies in general, but also many companies out of the Max 7 came into 2025 with high valuations, high stock prices, and then saw a real crash and retraction in their valuation throughout the first quarter of 2025, leading even into the second quarter of 2025. And so, therefore, if we measure the year-to-date performance for Nvidia, starting off here at the 2nd of January up until the current point in time, sitting at $170, that is only 24% of gains in Nvidia. I mean, still far out competing inflation and loss of purchasing power, but only 24%, while in the same time, the intra-year performance, bottom to top, we'd be looking at starting from the lows in April here of 2025 up until the top, we were looking at a total of 145% of gains. So same story as with all the other companies that we already tackled in part 1 of this tiny little mini series, but only to a larger extent. 145 intra-year performance is absolutely wild, especially if you look at it and compare it to the 24% year-to-date performance that we see here for Nvidia. Absolutely wild. So then overall, starting here out of these lows from the Trump's tariff crash, we saw a small 1-2 setup here. We then saw an extended wave 3 with 1, 2, 3, 4, 5 waves, impulsive move leading into the wave 3 top, which we saw in late October 2025. And ever since, we are right here working on the wave 4 corrective wave down. So far with a completed A, B wave, and currently working on the C wave, which should be concluded somewhere in the upcoming days or weeks, maybe potentially even within 2025 still. So if you are looking to place another position in Nvidia, I personally would wait just a little longer, because from those levels, and here we do not have an exact trading zone because it's rather undecided yet where this wave will end, but roughly let's just take 160 for good measure. Starting from this wave 4 low, then here we'd be looking at potentially 40 to 60% in the next wave, concluding the big overreaching wave 5 of the overreaching wave 1. Meaning, if you're familiar with Elliott wave terminology, a long-term overreaching wave 5 is then of course always followed by a long-term overreaching wave 2 corrective wave. Right, with Elliott waves we're always looking at a 5-wave structure: 1 up, 2 corrective, 3 up, 4 corrective, and then a final wave 5 up to complete the overreaching structure, which then in return of course is the substructure to another higher level of wave count here. And so for Nvidia, as soon as we manage to conclude here this overreaching wave 1 top here, we really are looking at an extended, prolonged correction, right? Everything that goes up must come down at some point, and boy did we go up. Do not forget, I mean, in the lows of 2022, when we saw this huge pullback in tech altogether, in those lows, we saw a low for Nvidia at $10.81. And right now we're talking about $170. So that's still 17-fold up roughly. So if now in return I'm telling you that in the wave 2 corrective wave that we see here for Nvidia coming up sometime in 2026, probably, that we're projecting a 50 to 60% correction here for Nvidia, please do keep in mind that the rough target zone for this wave 2 low here is gonna be in an area which still is 3 to potentially 6-fold higher than the low that we saw in only 2022. So only 4 years back then, from 2026, we saw a low in the Nvidia stocks still far, way lower than the corrective target that we now project here for Nvidia. So please do keep that in mind before you storm off to the comments telling me, oh no, Nvidia will never correct that deeply. I do not believe it. We'll wait and see. And we will bring an exact entry zone with coordinates here on the charts in due time. For now, we do only have an alternative entry zone, meaning in a potential alternative count, we could already have seen the wave 1 top here back in October of 2025. And if that was the case, remains to be seen in the upcoming weeks and the substructure to be developed here. But if the price action in the following weeks confirms this alternative count, we would already have a target zone here for Nvidia. So meaning if we directly fall through without establishing another higher high here for this wave 1, we would be looking at a long-term entry target zone somewhere between $40 on the lower threshold and $92 on the upper threshold. Huge area, I know, and we will define it more closely and condense it down as soon as we gain more confidence in this count. But for now, that's what I can give you here for free so far. And so let's directly jump to our next candidate, namely Meta. And in the past years, Meta really had investors wondering whether they have lost their mind with their billions upon billions that they poured into the metaverse. And I don't know whatever came out of it. I am not interested in it. I did not look into it because this whole metaverse endeavor, I did not get it from the get-go. They lost me already within the first presentation I ever saw of this stuff, so I don't know where we're standing here. But what I do know is that they really scaled down their investments into the metaverse. If I'm up to date, they still pour quite a bit of money into there, but they really scaled it way back down, and I guess we have to wait and see what really comes out of it. But then, two main growth drivers for Meta this year. One of them is that AI implementation into their ad revenue really improved pricing efficiency dramatically. Meaning the AI implementations that they brought to their advertising business really refined targeting to an extent that Meta can earn margins far from anything that they were able to earn in the past years. Also, after they declared 2024 as their year of efficiency, they now do benefit from a way leaner structure overall and therefore reduce costs altogether. And that's why if we look at earnings here for Meta out of the 2022 lows where they were only earning roughly $29 billion. Right now for 2025, we're looking at an expected $85 billion altogether. And we are also looking at a PE ratio of 28.3. Yes, that is expensive, but amongst the Max 7, it's rather cheap. And at the end of the day, it's all a matter of context anyways, right? But then, there's the downer already. If we look then at the year-to-date performance for Meta, starting off here again from 2nd of January 2025 up until the current point in time, we're looking at a 10% year-to-date performance for Meta. Not really all that great, not really that magnificent, right? Especially if we see here that from bottom to top within 2025, we're talking about here yet another 70% gains out of the Trump tariff crash lows in April up until the highs here in August. I mean, starting from April to August, 70% of performance. That is wild. And with such a performance ending the year on only a 10% overall gain, that is also wild. And right now, this is the 5th company out of the Max 7, and yet again, the year-to-date performance isn't great at all. It's not magnificent. Latest at this point, one really has to wonder, are we really in an overextended AI hype? Or did we already, for the past half a year, see a huge correction in disguise? Because sure, S&P 500 looks great, looks amazing, but if we look at the Magnificent 7 that have been fueling most of the S&P, they have been in correction mode over the second half of 2025. So then, what's our outlook? So, starting off here from those lows, these we had counted at only the wave A. So, from this wave 3 high here in February of 2025, we have counted this first corrective wave here as an A wave, a B wave to follow. And right now, we are working on an 1, 2, 3, 4, 5 waves substructure here to this overreaching wave C, concluding then the final wave 4 following this wave 3 here that we have established in February of 2025. And where then will that lead us, you're wondering, and you're wondering rightfully so. As soon as we manage to establish this wave 4 low here for Meta, somewhere probably already beginning of 2026, just a rough guess, right? Elliott waves, we cannot measure time horizons, we can only measure price targets. So this is just a rough guess, right? But as soon as we manage to establish here this wave 4 low in the area of roughly $500 give or take, up until the wave 5, we really would be looking at a potential doubling here in the stock of Meta, potentially even 120%. That is our clear target projection here for Meta. No target zone here yet. Again, I will be sharing details with you and updates on those target zones if you are subscribed to this channel here and turned on the bell notifications. And if you do not want to wait for videos coming up, randomly popping up every other day, then also down there in the description there is a link taking you to our website where you can become a paying subscriber to our market analysis service where we analyze 200 assets on a daily basis. You can choose from various different packages and get then not only updates on those stocks and our scenarios and analyses on those stocks, but also a full model portfolio management. You will get entries, exits, push notifications if you have our app. So if that is of interest to you, link there in the description, check it out. And so finally, we have arrived at Google, Alphabet, the infamous one. And Google really had to fight against many, doubting if in the age of AI and in the age of ChatGPT taking over search and online traffic altogether, if Google can manage to still hold up their ad revenues and if Google even can maintain any kind of income stream in the upcoming years, because ChatGPT was supposed to overtake everything. But even back when this question was still on the table, my take on that already was something that you can really learn from, because do not underestimate the power of branding. What do I mean with that in this case? The term I'ma Google that. That is a given in the English language. Another term, completely inwoven in culture and completely inwoven in everyday language. That's why a couple years back, when every other company started their own streaming service with Disney Plus and Hulu and whatever, there were the same questions on the table with Netflix. And back then again, also, my take was, admittingly not an original idea by myself, I heard that somewhere, but it completely stuck with me. So the take back then also was, Netflix has such strong branding power within language itself that they will not go anywhere. And I adopted the very same take for Google when those doubts were on the table. Googling something still is such a strong term, shaping language and therefore shaping behavior. So for many boomers, Xoomers, millennials, they still go to Google as a reflex, as an impulse, not because Google is the best choice at hand, but because it's just connected in my brain. If I want to search something, I'ma go to Google. That is a behavior pattern that I have learned over the last years, and it will probably take many years before I'ma unlearn that. Not saying that's a smart move, just saying that's the way it is. And so therefore Google really managed to still defend their reigning championship as the mothership of all search engines, and they really kept their ad revenue up. With of course the very same AI improvements in targeting that also Meta implemented in their advertising business. And then of course there still is YouTube. Google still owns YouTube, and YouTube is synonymous with videos online. Everything that is not a movie or a TV show is on YouTube, and even TV shows and movies are nowadays. So do not underestimate Google and do not underestimate YouTube. Those two are powerhouses, and those two have branding power within language itself and therefore are anchored in human behavior and also will be for many years to come. That's at least my prediction here for Google. But then what is our outlook for Google? And also firstly, the question that we here are answering for all of the Max 7 companies, what is the year-to-date performance for Google? And here already, even before starting the measurement, I can see that we are in for a treat, because starting from the beginning of January here up until the current point in time, we have a winner, ladies and gentlemen. We are looking at 60% year-to-date performance. I mean 58, right? What is it exactly? Yeah, 58% year-to-date performance for Google. That is now reigning supreme before all others. And again, similar story. The intra-year performance for Google, bottom to top, comes in at a whopping 132%. That's honestly way better than I had expected. Way better than I had expected. But still, 58% year to date isn't bad at all, and is right now the reigning champion in our top tier list of the Max 7 companies. But then again, in this case, there is another downer. You might maybe already have guessed it. Because starting from the wave 3 top here that was established in July of 2024 already, remember here, this is a week chart, so we are a bit higher up in the time frame. So starting from this wave 3 top, in 2024, we have seen so far an ABC corrective structure being concluded in, once again, the April lows of 2025 after the Trump's tariff crash. And ever since, we are now here in the following wave 5, concluding the overreaching wave 1 top in the area between $377 and $418. That is the area between the 161.8 fib extension and the 224 fib extension level. And these target zones that are rather imminent, usually we keep the exact coordinates to our paying subscribers, and I'm gonna just share here our rough outlook on YouTube. But because it is Christmas time, I'm feeling particularly generous and I'm giving these targets completely out for free. So if so far you haven't subscribed to this channel and you're still watching this video, please do so now to just give a little bit back to the free value that I'm providing here for you. I'd highly appreciate that. So let's continue with the bad news, because from this wave 1 top that we expect here in the just before mentioned area, we are looking at roughly a cutting in half of stock price here for Google in the year 2026, potentially dragging way further along, because with elliott wave theory we cannot predict and measure exact time targets, we can only measure and predict price targets. But either way, we are looking at roughly a 50% correction in the stock of Google as soon as we manage to conclude this overreaching wave 1 top here in the before mentioned area between $377 to $418. So then that leaves us with only one company to wrap up the whole Max 7 package. Of course, it is Tesla. And Tesla, I mean, what shall I say? On a macro level, of course, Tesla has been under huge pricing pressure in the EV sector because there's so many companies, especially out of China, that deliver real solid EVs at amazing prices. And if it was not for tariffs, I don't see how Tesla would be selling any vehicles at all anywhere except for the United States. But especially in 2025, we saw a takeover in the driving factors for the Tesla stock of, first of all, robotics in general, the Optimus robot, which isn't market ready yet, but still made huge headlines. And then secondly, the self-driving improvements to their software, the full self-driving is about finished. It is right now more a matter of just the legal steps taken rather than a matter of development. And so in that regard, Tesla is up ahead before all other car makers out there. And on a mere numbers and financial level, what shall I tell you? I don't see any gain really in talking about Tesla earnings. They have been in the red for a long time. Nobody cared. Then they made money. Nobody really cared. Now they're not making as much money anymore. And nobody really cares. PE ratio currently sitting at 299 and nobody really cares. In the meantime of the last years, they have been at a negative 630. They have been at a positive 964. PE ratio just isn't a factor in Tesla at all, so let's not waste any more time looking at it, but let's take up some time measuring the year-to-date performance for Tesla. And for this I really am excited. I did not measure those performances before the video, and so starting from, this is here, the 2nd of January 2025 up until current point in time, even though we are at the all-time high here in Tesla stock price, we are only looking at a year-to-date performance of 16%. And yet again, the intra-year performance, of course, from bottom to top was way better, far outnumbered it at 130%. So roughly 8 to 10 times higher than the whole year-to-date performance for Tesla. Meaning, of course, Google keeps the lead, followed then by Nvidia, and number 3 should be Tesla, but you should also see this right now here on this chart. Our magnificent Mag 7 leadership board, that's what I'm gonna call it. So outlook for Tesla here on the 4-hour chart. So in the short to midterm outlook here for Tesla on the 4-hour chart, in the recent, maybe not so recent past, we had established a target zone here for a long entry in Tesla in this here calculated wave 4. But sadly, I'm gonna be very honest with you here, we overshot this target zone to the downside at 1.8%, and we have a strict rule in our portfolio management. If a target zone is overshot to the downside at an extent of more than 1%, we will stop out the position. We will put a stop loss directly 1% under the lower threshold of our target zone. So in this case here, the analysis was correct because we really did see a pivot point here. However, the portfolio management in this case was faulty because the stop loss here kicked us out of the position instead of leaving us in, and from the middle here, for example, from this target zone up until the current point in time, bringing us in 20% of gains. We missed those gains, even though the overall analysis was correct. And so, of course, we conclude here that we'll be seeing an overreaching wave 5 here to follow this wave 4 here. And then this wave 5 in red should conclude an overreaching wave 1 high here. Of course, you know the drill, a wave 2 corrective wave to follow at roughly starting from the expected levels for the wave 1 top. And again, we will probably bring a target zone here on this chart in due time. But if you just give me a rough estimate here, from those levels at roughly 550, we'd be looking at another 40, 45, potentially 50% correction in Tesla here in the upcoming wave 2. Sounds like bad news. However, long term, we really do have a super bullish case for Tesla. We really do see, based on the wave structure, an amazing future, bright future. We really do see, based on the wave structure and the price actions in the past, we do see a bright future up ahead for Tesla. And we even do already have a long-term wave 3 target zone here. So following this wave 2 low, which was concluded in April of 2025, yes, yet again, the TTC, yes, yet again, the TTC lows, the Trump tariff crash lows. So from those levels up until just the lower threshold of a wave 3 target zone here, 300% to roughly 390, let's call it 400% on the upper limit. Of course, yet again, this target zone will be further refined and condensed down as soon as we move further along here. But overall, even from current levels, without any major corrections in between, we'd be looking at another 100%, and starting from the just mentioned before wave 2 lows here, we'd be looking at probably 170 to 220% for Tesla. May these price developments in the stock of Tesla then be due to the full rollout of their self-driving and a sweeping fleet of Tesla taxis that drive everybody on the globe all around for free? Or may it be to Tesla mining on spars? I don't know. Doesn't matter at this point in time. But based on our wave counts and on the price structure, we clearly do see a structure leading us to this point eventually, and probably without any new lows in between. That's a very clear call. We are right now positioning ourselves and making that call that these lows of $214, which we only saw this year in April, will never be met, at least will not be met before we see the area of $900 to $1,000 for Tesla. That's our call. And with that call, I'm gonna leave you here, wish you a Merry Christmas, see you in the next year, maybe even this year still. I'm gonna leave that open for now, but either way, if you wanna see me again, please do not forget to press the subscribe button here, turn on the bell notifications, and up until then, see you in the next one. Take care.